The next one is Luca Ferrari. This is co-founder and CEO of Bending Spoons. For us, it's a new world. So, Luca, thank you very much.
Hello, can you hear me? Yes, you can. Nice to be here. Thank you for having me. Thank you for the invitation. All right, so who are we? What do we do? Maybe some of you have heard of us before. We're a technology company, an unusual company. Most companies are built to create a particular product or relatively narrow set of products, and that's a perfectly sensible way of building a company. In our case, we took a different approach. We built a platform, technologies, expertise, talents, company culture, data, fully optimized for acquiring existing digital technology businesses with untapped potential and then transforming them so they can be more successful. This happens in two phases. Phase one, after the acquisition, we join, when I say we, I mean a lot of colleagues from Bending Spoons join the acquired business at all levels, not just managerial levels, but individual contributor positions too, and spend a few weeks, sometimes a couple of months, studying everything important about the business down to the finest details. And then we regroup and define a vision of the most successful version of that business we can imagine. And that's when phase two starts. In phase two, we get to work to close the gap between the status quo and that vision. And the change generally spans the full spectrum of components of a business, from the technology to the user experience, the marketing, monetization, organization, processes, everything. So I like to joke that Bending Spoons is a bit like the baby a private equity firm and Google never had. From a private equity firm, we take the focus on acquisitions, financial savvy. From Google, we take the fact that we are technological operators. Most of our time is spent building technology products. We roll up our sleeves, get our hands dirty, actually doing the work. It's an unusual combination. I'm not aware of any company quite like us, for better or worse. It's been reasonably successful for us over the past 10 years, 11 really. We've been able to grow to about $700 million in revenues this year, and we serve 200 to 300 million monthly active users, depending on how you define an active user. And we've been profitable every year since our foundation. So what does it work? Why have we been able to do well enough with this approach? There are different reasons. The first one is the platform I mentioned. It's taken a lot of time and sweat, blood and tears to build this platform, particularly the insights, the know-how, but also the technologies. I'll talk about that in a moment. Our employer brand, our talented team, our company culture, everything has been optimized, and we continue to improve it to do exactly what we do, which is acquiring and transforming digital technology businesses. This is a massive advantage, both at the acquisition phase, because when we face off with, say, a private equity, because we can generate greater value from a business thanks to this platform, we can also bid higher. We haven't lost a process as yet. Well, we did lose one in 2019, but because we didn't have the money, not because we wouldn't have offered more had we had it. The second reason is structural. There are efficiencies to be unlocked by bringing together multiple businesses under the same umbrella and integrating them deeply. I want to stress this again. We transform these businesses often down to the software, rewriting the code base, changing the user interface. Like we truly integrate pretty deeply, and so massive efficiencies are unlocked. Not just some obvious ones like, okay, you just have a finance team. Sure, that's maybe 1% EBITDA margin, but or additional percentage points in EBITDA margins. But truly, most of it is being able to move around R&D people toward the opportunities for greatest impact without being psychologically incentivized to look for value where value isn't to be found, which happens when you only run a pretty specific business. It's really hard to say, we're done here, we should be looking for something entirely different. It's pretty easy when you have a diversified portfolio and you keep adding to it. And of course, as you build technology, you can share it across all these businesses. That's much more efficient. For example, we built our own payment platform, so to say, that's integrated with all the, the Stripes of the world, and the very same technologies used across all our products. Or our A/B testing platform that's also used across all of our products. And on and on, there are about 50 such technologies we've built over time. And then lastly, this specifically relative to a private equity. Of course, a private equity generally works with funds. They have to sell a company. That's a very successful model, of course. We buy off our balance sheet, typically to hold and operate forever. We haven't really sold anything of substance so far. And this makes certain targets interesting to us that would be not so interesting to someone if they have to sell it within a few years. We have over 100 products. The main ones, we list them here on the slide. Evernote, one of the main productivity suites globally, acquired it almost 2 years ago. Issue, to my knowledge, #1 digital publishing platform. Globally, Meetup, #1 real-life event organization tool. Remini, the leading AI-based video editing and image generation tool on mobile. I'll talk more about it later, but Remini has over 100 million monthly active users. It's the second most used generative AI product in the world, only behind ChatGPT, which I think has maybe 150 to 200 million monthly active users. Splice, a leading mobile video editor. StreamYard, the #1 video recording, video streaming platform globally. WeTransfer, a file storage and sharing tool. We're very diversified. You see a wonderful pie chart here. And we're also diversified not just by product, but by currency too, by geography. We're a little bit all over the place, with the US being our #1 market, but even there we only generate about 40% of our revenues. And also by main, let's say, payment platform, as we have the Apple App Store as a platform. We have Google Play. We have web with multiple providers, Stripes, PayPal. Our markets are large. I don't think it's especially interesting to linger here, but whether you want to categorize it as consumer, mobile, or SaaS, and everything in between, we're a speck of dust relative to the market we operate in, so we do not see any saturation effect kicking in the foreseeable future. We've been able to grow largely through our reinvested earnings in debt. We also raised capital in moderation here and there. We're happy with a strong roster of investors. Of course, TIP was the first institutional investor to believe in us. Very grateful for that. It's been a wonderful 5 years together, I think. I could not recommend them more as an investor. And in recent years, we have welcomed also other international investors like Baillie Gifford or Durable Capital. We still, as a management team, as a co-founder team, own around 2/3 of the capital and of the votes, which could be a good or bad news depending on your views on our abilities. We've grown reasonably rapidly over the years. Revenue-wise, as I said earlier, we are about $700 million this year. CAGR has been 50% over the past 5 years. We've been highly profitable every single year, and growth has been driven, of course, by the acquisitions, which is our #1 engine, and also by growth of each of the acquired products. Our transformations have led every single time to growth at a minimum in the couple of years subsequent to acquisition. So now let me tell you a little bit more about the platform I mentioned earlier, so it's not as abstract as it may be at this point. A good way to think about it is the hard part, technologies, the expertise, the data, and the software. But in my view, more important part of our employer brand, the talents, the company culture. With regard to the harder part, the tools, the expertise, we could talk about this for a long time, but the short of it was we built a lot of proprietary tech that we leverage to run these businesses more effectively, more efficiently. One example is Minerva, what Minerva does is it it's a machine learning tool. First of all, it's a fully automated tool. Predicts user behavior years into the future. So as we acquire millions of users, Minerva will observe certain behavioral patterns over a few weeks or months and then project what these users will do over time, thus telling us on average how much we should expect in terms of revenues from that user, for example. And this is paramount for a lot of things we do, from very basic things like, but important things like optimizing pricing. We can test various price points and see which one is most efficient, to more sophisticated things like optimizing the broader user experience or acquiring users and customers through paid advertising channels. And Minerva is key in that regard too. It works nicely in tandem with a bunch of other automations, for example, enabling us to run very finely tuned advertising campaigns across channels such as search channels, whether it's Google search or Apple search ads. And here our tools will look at each keyword or key phrase, millions of keywords, and adjust our bid, how much we're willing to spend to acquire a user, continually every few minutes over multiple languages. And for all of our products, based on the knowledge of the value of each user that Minerva and other tools provide these sort of automations with. So it's an ecosystem of tools that whose value becomes greater in many cases when they're brought together. There are many others, probably not worth spending too much time on, but Lumen is essentially a data storage and analytics layer. We use it across the board. Pantheon helps our AI researchers deploy machine learning models in production at scale, and also A/B test different versions of the same model, which is very important. Role Model supports our recruiters in dealing with the incoming job applications and making good decisions, including with AI. I'll talk a little bit more about our recruiting in a moment, but Role Model is a powerful tool for us in that regard. And now on to the softer, but more important, as I said, part of what we do of our platform. We're blessed with a strong employer brand and a great appreciation of our people. We call ourselves Spooners. Working at the company, we have very high levels of satisfaction, only about 1% unwanted team member churn. Most companies in technology have around 10%, some even as high as 20%. Consider that the people we hire could go work at Google, at Apple, at Meta. It's not easy to retain this sort of professional, but we are blessed with essentially perfect loyalty so far, at least. Some of the highest scores on Glassdoor, at least of those I've seen, and we've won a bunch of awards as one of the best places to work in Italy and in Europe. And it's not, I'm often asked why is that the case. It's not about the benefits, although those help. The key factor why people want to work at Bending Spoons and stay is the talent density. They were obsessive when it comes to keeping the bar extremely high with the quality of our teams, and talented people, ambitious people want to work surrounded by even more ambitious, even more talented people. So if you can be uncompromising when it comes to that, over time a virtuous cycle is ignited, and it becomes a massive competitive advantage where these people will tell the other people they know who are exceptional they should come over, and then nobody leaves. In fact, let me see if we put it here. Okay, we didn't put it on the slide, but my favorite review on Glassdoor says something like, "This job is so good that I'm stuck here forever," which I thought was funny, but also the best compliment a teammate could ever give a company. As I said, we are a highly desirable place to work based on anonymous white label surveys we ran over the past few years. We tend to, at least in Italy and Southern Europe, come out generally a little bit above Apple and a little bit below Google. We've been catching up, we'll see, and definitely above of other sought-after brands like Microsoft, Meta, Amazon. Last year we received 100,000 job applications. This year we expect to receive about 400,000 unique job applications and only hire about 100 people, so 1 in 4,000 people who apply in 2024 get a job offer. And job offer acceptance rate is about 90%, 95%. So as I said, we drive growth through acquisitions primarily. The way we approach them is not so interesting. I think most of it looks a little bit like the process a private equity would run. We have a big pipeline of possible targets, 5,000 new companies added over the past 12 months, and then we trim it down with analysis and rules of thumb, yada yada yada. Ultimately, we acquire only a handful of companies. We try to be very selective, patient, and disciplined. The part where I think we stand out a little bit, of course, the main part is post-acquisition, the transformation, the platform. But there is at least one unusual aspect pre-acquisition, which is I believe we're more sophisticated and scientific in projecting the potential of a particular company, at least in our sector, than the overwhelming majority of our competitors. And this is due to a combination of factors. One is just culturally, we are a highly scientific, rational company. We have a big advantage in acquiring so many different businesses. Of course, we can see patterns, and we have a lot of data we can leverage. And lastly, because we're so hands-on and we transform each, and we're in the trenches looking at the details, that will typically give us a major edge over again, a private equity firm, which would be naturally a little bit more shallow in their interventions. So all in all, this part is probably not the most interesting, but I figured you want to know about it anyway. And let's conclude by talking about two examples. One is Evernote. Evernote is a productivity suite, one of the oldest, to my knowledge, in the world. It's been around for 20 years. It's been used by 250 million people. We acquired it a little less than 2 years ago, and we have since completely transformed it. Well, we're not done with it, but we are probably 50% through a transformation. We have re-architected most of the IT infrastructure, going from a kind of awkward cloud infrastructure to fully native cloud infrastructure. We have rewritten some of the most critical parts of the code, and we're about to dismiss a major we call it the monolith. It's a huge Java 11 file that was running the whole Evernote. It's terrible practice in software engineering to just have one file, 20,000 lines. You could imagine that every time, it's like having a document of, 1,000 pages where every time you change a section or a paragraph, you could break everything else. You'd never be able to expand that document effectively. It's similar with code, just worse. So we've been working hard on dismissing that massive file, and we should be done this year. We've improved performance, reliability, redesigned the UI completely, so it's much more modern and fresh. Launched many major features, including AI search. With Evernote, you couldn't search with AI before, so search results. Search was actually pretty good, but search results were always just a list of notes, which is not ideal if you're looking for a conceptual answer as opposed to you're looking for a particular note, which is like 50% of the time for people. And now the tool answers like a personal assistant would. It will read your notes, the relevant ones, put together an answer that draws from different notes and present it to you. The notes are referenced. You can also read all the sources, but it's way more efficient in about one case in two. And we've also launched by now over 100 what we call quality of life improvements. These are smaller features, refinements, bug fixes that have greatly increased user experience. Customer support tickets are at the lowest point ever. Customer retention is the highest it's been. Revenues used to be stagnant around $90 million. They're now at about $130 million. And Evernote had lost quite a bit of money historically, about $250 million in its entire history, and is now profitable. Oh, and also it used to be run by a team of about 400 people, 370 people, and it's now run by a much smaller team. So we've been able to, by going leaner in terms of operations, we have actually, at the same time, been able to improve the rate of improvement and innovation of the product. Another example is Remini. It looks entirely different on the face of it, but the approach underneath is essentially the same. Remini is a photo enhancer based on AI, so you input a photo, maybe a blurred photo, maybe a low resolution photo, and it helps make it sharper. We bought it 4 years ago from a tiny Chinese company. This was an asset deal, so we didn't get the team here. And we have since completely rebuilt it. There is nothing in today's Remini from that product. Not a single line of code is the same. Not a single pixel on the screen is the same. We dropped a lot of features. We added new ones. And last year, we introduced a set of features we call AI Photos, which is generative AI used to create synthetic images that look like a photo of a user that was actually taken in real life. That was a major breakthrough. As far as I can tell, we were the first in the world to do that. The app, for a while, was the most downloaded globally. It's still one of the most downloaded apps in the world. But at that point, at the peak, millions of people downloaded it each day. When we bought it, Remini generated about $10 million in revenues. Today, it's a $140 million product, also profitable. And again, as I said before, this was a complete transformation, starting from a valuable, good seed of a nascent brand and a good customer base. I think that's it. Yes, it is. Did I make it in time? Thank you very much.